Good morning. This is John Richardson speaking with you from Toronto, Canada. Today is Friday, August the 4th, and I continue my series of podcasts with a U.S. tax lawyer, in my opinion, one of the world's most famous tax lawyers, Virginia La Torre Jeker, who has written a fabulous blog post on the net investment income tax, and this is a topic that is of interest to everybody, but most interestingly, I think especially to Americans abroad subject to the U.S. tax system. Welcome, Virginia. How are you today?
Hey, John. I'm doing great. I hope you are as well.
I am. Well, why don't we start off with this? Would you agree with my comment that this is of particular interest and impact when it comes to Americans abroad? Would you agree with that?
Oh, absolutely, because there are so many nuances that hit the American who is living abroad with regard to his employment income earned overseas, if he's owning certain foreign corporations. That it just gets really, really tough for the U.S. person who's living abroad when he's dealing with
The irony, of course, is that this net investment income tax was designed to fund Medicare for American residents, right?
Yeah, this was enacted to help fund Obamacare. And, unfortunately, Americans overseas, as far as I know, aren't entitled to any of that.
Well, I think that's right. So I think that makes a lot of sense from a U.S. point of view. Let's get somebody else to pay for it, right? Why
It's
not?
always the way, right?
Yeah, citizenship taxation, the only way, the American way. All right, why don't we start with first principles? And if I could just make a comment before we start and ask you to confirm if you think I'm right. But this net investment income tax really needs to be seen, I think, as a separate tax regime with its own rules. And in that sense, it's sort of similar to the alternative minimum tax, right?
I think that's correct. Absolutely.
Okay, so brand new tax, more change we can believe in, I guess, etc. Okay, so how much is this tax anyway, and what's it based on?
So this is a 3.8% surtax on what's called net investment income. And it doesn't apply to everyone. It applies to supposedly only high-income individuals. So whether you are going to be assessed this surcharge will depend on your modified adjusted gross income. And it will also matter which filing status you use. So for example, if you're married filing jointly, the MAGI threshold, modified adjusted gross income threshold, is $250,000. Once you hit that number, then you will be subject to the net investment income tax. If you're married filing separately, it's half of that, $125,000.
Okay, now that's very interesting. Let's just pause on that for a moment to make sure people understand the gravity of that. Most Americans abroad, if they're married to a non-citizen, would, I think, presumptively file married filing separately. Would you agree with that?
That is, for the most part, John, I would say that's the default. People will file married filing separately because they don't want their foreign spouse to be dragged into the U.S. tax net. Right. Now, having said that, in certain cases, of course, it can be beneficial to do a married filing jointly return with your foreign spouse. You need to really speak to a qualified tax advisor and see if this is going to be beneficial for you or not. For example, if the spouse is working and only earning employment income overseas, that spouse will also be entitled to the foreign earned income exclusion. And then in that particular kind of case, it might be beneficial to do married filing jointly and treat the U.S. spouse, the foreign spouse, as a U.S. taxpayer. You have to make a special election. It gets a little bit complicated, but with the proper advice, you can find that this will really save some tax dollars. But when you have the couple, when the foreign spouse has a lot of investment assets, for example, then typically, yes, that couple will be doing married filing separately. And I think, as you're going to point out, the threshold is quite low.
That's right. So, I mean, to put this in very, very simple terms, if the threshold for marrying filing separately is 125,000 less, that means that there's actually 3.8% times 125,000, which is an immediate, what can I say, surcharge on married filing separately, right?
That's right.
Yeah, I mean, that's it doesn't sound like anything until you're actually hit with it on paper.
Correct. And the people stateside who are married will not generally choose married filing separately. But the couple living abroad, where one is a U.S. person and the other is not, they will generally, the U.S. person will use that status married filing separately to keep the foreign spouse out of the U.S. tax dragnet.
Right. Since we're talking about this, I think it might be worth making the point. I think I'm right in this, and maybe you can either agree or correct me if I'm wrong. But I believe that once they start with the married filing jointly, with that 6013G election, I believe that remains in effect until they take specific steps to terminate that, right?
That is correct. It will automatically terminate, I believe, on the death of the spouse, and it will automatically terminate. There's another situation, I can't remember what it is, but there are some situations where you don't have to revoke it if certain things happen. But I think you're right. People should know that 6013G election, you have to take specific steps to obtain the married filing jointly status when you are involving a non-U.S. spouse.
And to end it.
That's right. It continues unless ended per the code, the tax code, or ended because you have specifically revoked it.
Right. So, that is very, very important. I think, well, on both sides, but, you don't want to start.
Once you revoke it, you can't get it back.
That too.
Yeah. I mean, there's very precise rules on this that people should clearly take proper advice before they make the election and before they revoke it if they've made it.
So would you say then that, I mean, let's say somebody calls you, Virginia, for advice. Would it make sense to make sure that you talk about this in two categories? First, is there any tax benefit to married filing jointly at all? But second, oh, by the way, if you do this, there are specific rules for termination and ending, okay, and you need to know about those as well, right? So even if there were a short-term benefit, maybe it's not worth it because of the bureaucracy and the rules for electing it and terminating it. Does that make sense?
Yes, and getting it back again once you do terminate it.
Okay, so a bit of a detour there, but very, very important, I think. Okay, now 3.8% surtax on net investment income. What's investment income, let alone net investment income? What does that apply to?
Well, it applies to things that are, for example, passive income like interest or dividends, capital gains, annuities, royalties, passive rents, or any other income from businesses that are considered passive with respect to the particular taxpayer. Because as you know, in the code, we have passive activities rules.
Sure.
All of these things are dragged into this net investment income category.
Okay. It occurs to me that at the sale of a principal residence would be investment income, and threshold is 125 or 250. It seems to me very, very likely that in the year that somebody sells a house with a capital gain, they're going to be hit with this. Would you agree?
They can be. Just to correct you on the numbers, John, It's 250,000 as the exclusion of capital gain on the sale of a personal residence.
Oh,
So
yeah,
the
no, yeah,
exemptions-
that I understand. I meant in terms of the thresholds for.
Aha.
But
Oh, I see.
absolutely, yeah. To be clear,
Yes,
uh,
that's correct.
yeah,
Anything
to be clear,
exceeding
the
that.
first 250 of the
Mhm.
gain would be
Mhm.
excludable,
And 500,000 for joint
right?
filers.
Yeah, so that's interesting again, because it seems to me that's another issue to help people determine, are they filing separately or jointly, whatever. But okay. So passive income, net investment income. Now I noticed in your blog post, and by the way, for listeners, we're kind of talking off what I really think is one of Virginia's greatest blog posts ever. Is this recent one, July 27th, 2023, that's talking about this net investment income tax. But what you comment here is that it doesn't apply to things like IRAs and 401ks and stuff, right?
Correct. So a distribution from a qualified retirement plan, that distribution is not counted as being, passive net investment income. Similarly, if you got income from a tax exempt municipal bond, that wouldn't count. And if you look at these exemptions from the surcharge, it makes good economic sense. Like Congress does not want to discourage a taxpayer who's investing in his own retirement planning. Obviously, we know the Social Security system is having its problems, so they want to encourage people to invest in their retirement planning. So they're not going to hit you when you get a distribution from a qualified plan. And the same for investing in a municipal bond and getting interest on that. That won't be included. I mean, debt obligations issued by a state or a city, they use that money for important, public civic projects. So Congress doesn't want to discourage people by having the surcharge apply to that kind of income.
Right. We look at the 401k in Canada and many other countries. In Canada, it's called an RRSP. They have similar programs where you contribute a certain amount, it's a tax deduction and grows tax free. I've always found it interesting that the distribution from the Canadian RRSP would be caught under the net investment income tax, whereas the distribution from the 401k would not.
Interesting.
Well, I mean,
again, John, as we have said time and time again, anything foreign is always troublesome.
That's right.
Not liked, let's put it that way, not liked by the government of the U.S. or the tax authorities of the U.S. For whatever reasons, I don't know. I think they just are not thinking through the repercussions and thinking that, gee, the only thing that is worthwhile is a 401k or, one of our qualified plans, but no other country's qualified plans are worthwhile.
It's really incredible, isn't it? Because in this conversation, we've identified already, two areas where this really discriminates Americans abroad. First, in the tax filing thing, married filing separately, it's a lower threshold before people are subject to the net investment income tax. But, then we see that these qualified, retirement plans in other countries, the distributions are included as being subject to this net investment income tax. And, as we said at the beginning, the whole purpose of this is to fund health care for resident Americans.
Yep.
Amazing stuff. It's very, very common for Americans abroad to invest in mutual funds that are non-U.S. and there's that word PFIC for that, right? Passive Foreign Investment Corporate Company, and I think even more, equally common for them to run their business through small business corporations. What happens, if you get income from a foreign mutual fund, a PFIC or a distribution from a foreign corporation. Is that net investment income?
Oh my goodness, John, that gets very, very complicated. Under the surcharge rules, that U.S. shareholder can make an election to include a undistributed income from the CFC or the PFIC in his net investment income for the 3.8% surcharge in the year in which the U.S. shareholder actually pays income tax on that undistributed income. Because these anti-deferral regimes where foreign corporations can be CFCs, controlled foreign corporations, or PFICs, passive foreign investment companies, they make the taxpayer, they make the U.S. shareholder pay tax on income that he has not actually received from the corporation. So it's a deemed income that he is getting. And of course, all of this pretend income is going to be taxed to him on a current basis on his Form 1040. So we have this bit of a disconnect, like what do we do with the 3.8% surcharge? How do we handle that? And the answer in the tax rules was to permit the U.S. shareholder to make an election. He can include the undistributed income in his net investment income for that 3.8% surcharge in the same year in which he pays the U.S. income tax on that undistributed or pretend income. So this allows the shareholder to treat that undistributed income in the same manner. It's a consistency. He treats it as taxable income for both his U.S. income tax purposes and for purposes of the net investment income tax. If the election is not made, then he's got this inconsistency for the different tax years involved. So he's required to pay the 3.8% surcharge in the year he gets the actual distribution from the CFC or the PFIC. But this actual distribution he gets is not included in his regular federal income tax on that year's tax return because it was previously taxed in an earlier tax year under the PFIC or CFC rules. So it can get very messy.
Oh my God.
Yeah.
I mean, that is so complicated. I mean, let's just backtrack and just reinforce a few basic points that I think are at the root of that. First of all, reconfirming that the net investment income tax regime or system is a separate system than the normal income tax system, right?
Absolutely, absolutely.
Secondly, when we talk about CFCs or PFICs, actual distributions, leaving aside deemed actual distributions, are, dividends, for example, or distributions from mutual funds, do qualify as investment income, period, correct?
That's right.
But then we go further and we have the problem that with CFCs and PFICs, sometimes there's pretend income or deemed income that you never received, right?
That's correct.
And what you're telling me is that deemed income is also net investment income, correct?
Yes, it is.
Oh my God. It's just that the only benefit you get is that maybe you don't have, so even though you have to include the deemed income from an income tax point of view, you're able to defer it from a net investment income tax point of view, correct?
Yes, and until you actually get the money, the distribution.
So you actually get it out, but your reward for that is more forms, more complexity, more accounting fees, and more sleepless nights. Agreed?
I would agree, yeah. I would agree.
Oh my God, that is amazing stuff. But surely, Virginia, surely these taxes paid to the U.S., surely they have to be offset by taxes paid to the other country, right? I mean, you can use foreign tax credits to offset the net investment income tax, can't you?
Unfortunately, John, you cannot use foreign tax credits to offset the net investment income tax.
Are you kidding me?
No, I'm not kidding.
Can you say that again?
Goes back to what you were emphasizing frequently in this podcast, is that the income tax is completely separate from the net investment income tax. They are two separate regimes, and the way the tax code is structured, it's very complicated. The prohibition from using the foreign tax credits to offset the net investment income tax is due to the fact that the Internal Revenue Code is structured in a certain way, and it refers to, I don't want to get into the code sections, etc., but the way the code is structured prohibits you, let's just put it that way, from using the foreign tax credits to offset the net investment income tax.
So for Americans, I mean, that's shocking. So for Americans abroad, then, isn't this just pure double taxation?
Well, unfortunately it is, but I will caveat all of this by saying, if the taxpayer uses the foreign income taxes that he pays as a deduction on his tax return, as opposed to taking them as a foreign tax credit, then some or all of that deduction can be used to offset the net investment income. So someone in this position who's paying, foreign tax and using foreign tax credits, maybe he should be discussing what's the best situation for him with an experienced tax advisor, but it gets very complicated.
Well, let's take a very simple example there. So let's say that we have $100,000 of, let's say we have let's take a bigger number. Let's say we have $1 million of net investment income over and above the threshold. So the first point is, so it's going to be a 3.8% tax on that, which is what, $38,000, right?
Correct.
And that cannot be offset by what's probably the higher tax paid in the source country. But if I'm understanding you correctly, what you're saying is, well, hold on a minute. Yeah, that's real bad. But let's go to the itemized deduction section of your tax return. And maybe we can use that 38,000 under the itemized deduction heading. Is that correct?
They're taking the foreign income taxes as the deduction. And I think what you're saying is, you're saying the 38,000, that's the net investment income tax.
Sorry, the extra, yeah, you're right. The extra amount of foreign tax paid.
Yes.
Would be then used as an itemized deduction, correct?
Correct.
Okay.
And that will be reducing your net investment income by taking the deduction.
Okay.
That will reduce your net investment income, and then you apply the 3.8%.
So it will lower it. So it has the effect of lowering it to some degree.
Yeah, lowering it to some degree, whereas a foreign tax credit reduces your taxes dollar for dollar. So if you had $100 of foreign tax credit and your income tax owed to the U.S. government was $150, then you use the foreign tax credit to offset your $150 of U.S. tax owed, and you end up owing the U.S. government only $50.
Right. Okay.
But the deduction doesn't help you that way. It's not dollar for dollar.
Sure. Yeah, it just reduces the income that's subject.
That's right.
Yeah.
Let's just add one thing in, John, that we have missed that's important for people who are living abroad. Many people want to know, well, gee, I get my $120,000 foreign earned income exclusion. Can I use that to compute what my net investment income is? Doesn't that work and help me? Unfortunately, it does not. They have to add back the amount of the foreign earned income exclusion that they've taken in order to compute this net investment income surcharge.
Yeah. Another awful aspect to this.
Yep.
I mean, certainly discussing this with you today confirms my impression of your blog post. that Americans abroad are much more significantly impacted by this than resident Americans.
Yes, absolutely, absolutely. And I think, John, as you pointed out, they don't realize it until it's on paper and they see.
Yeah, that's right.
Yeah,
That's exactly right. There's also no doubt, Virginia, that that writing this thing in a way to prevent the use of the foreign tax credit to offset it was really just a deliberate attempt to put a 3.8% surcharge on investment income earned in other countries. Would you agree?
it certainly sounds that way. I mean, they could have taken this into account. I mean, I know it's a technical reason due to the way the code was structured, but a simple sentence could have cured that.
Well, I think the fact that it's a technical reason is proof of the intent.
I don't know.
There were, this was when did this come in? Was it 2010, 2012?
Somewhere around there.
There was a lot of discussion on this at that time, and I remember listening.
Oh, okay. If there was a lot of discussion, it wasn't an oversight.
It was not an oversight. Yeah.
Okay, so there you go. There you go.
So a final indignity inflicted on Americans abroad. I mean, it really is amazing. And, just to kind of cap this, I presume
They treat foreigners better than the American abroad. Let's put it that way with regard to this. Non-resident aliens are not subject to this 3.8% net investment income tax. So
absolutely not. Absolutely not.
Foreigner owning investments or properties in the U.S. and earning passive rents or dividends or capital gains, he's never going to pay this net investment income tax.
Actually, you make an incredibly important point, and I would like to invite you to explain that a little more fully, maybe with an example and some actual numbers. I mean, I think that's so shocking that America would discriminate against its own citizens in that way. Could you explain that?
Gosh, John, numbers are not my thing. But
let's keep it real simple. So
yes,
we have two small apartment buildings beside each other. One's owned by an American citizen, the other owns by a non-resident alien. Okay, they each generate $1 million of profit. Can you take it from there?
So this is passive rent that they're earning?
Yes,
what was
passive rent.
Okay, so the foreign person in the United States investing in that U.S. property, he has to file an income tax return and pay tax on that rental income. And he'll pay tax, assuming he makes an election to treat it as effectively connected income, he'll pay tax at a maximum of 37%, full stop. Now, the American living overseas who has invested in this foreign property and is earning rent, if he earns that $1 million, he is going to pay, after taking his deductions and so forth, he is going to pay tax at the maximum rate of 37%, but then he's got to add on top the 3.8% net investment income tax. So what would the 3.8% yield to him? At the end of the day, he's paying tax at 39.8%. Oh no, more.
Well, he's paying an extra $38,000. That's I think the point here, right?
So the U.S. guy is treated worse than the foreign person.
No question about it. Or to put it more specifically, the American citizen abroad, right, living outside the United States is treated worse than the non-resident alien. But I mean, this is one more example of, I think, a consistent theme.
I would say that's correct. Now, the U.S. government wants to obviously encourage foreigners to make investments into the United States. Okay, so properties, stocks, etc. None of the dividends or capital gains they earn will be subject to this net investment income tax. In fact, capital gains on sales of U.S. stocks aren't even subject to U.S. income tax for the typical foreigner abroad.
That's right, that's
Yeah.
right. But remember what happens when the non-resident alien who's a non-domiciliary dies with property and with that $1 million property in the United States. What happens then?
If he's domiciled,
If he's not
subject to
domiciled, he's not
not
domiciled.
domiciled, okay, then he only gets what's equivalent to a $60,000 exemption amount. And he must pay a state tax on the amounts above the 60,000, which every non-U.S. person I know who has invested in the States has significant investments. There's no way this small $60,000 exemption amount is going to help.
Yeah, in other words, close
But
to
there is
40%
planning they can
value.
do. They can come up with ownership structures to take care of the estate tax exposure. There's no doubt about that.
Yeah. Well,
I think,
again, this is really a fabulous blog post. It's an eye opener, and it talks about, you know, I just think an indignity inflicted on Americans abroad that is rarely discussed. But you know, this is a particularly egregious example, I think, of the abuse that the U.S. government inflicts on its citizens abroad. Particularly egregious.
yes, it's quite bad. And let's just end this by saying those U.S. citizens who have had enough and want to expatriate, if they are going to be treated as what we call covered expatriates, meaning they are presumed to have a tax avoidance motive, for example, if they have a net worth over $2 million on the date of expatriation, they covered expatriate will be hit with this net investment income tax in a harsh way, because they will be treated as you know, as selling all of their worldwide assets, which results typically in capital gain. And the net investment income tax will be applied on that pretend gain. They haven't sold anything, but the net investment income tax is going to hit them on that deemed gain upon the exit. So yeah, it's pretty bad.
And you know, and one final point here. Oh, it's unbelievable. In fact, it's so unbelievable that I think most people wouldn't even believe it. But you know, you make this point here, and we can probably close on this, that President Biden's Green Book proposals suggest extending the net investment income tax into other forms of income, right?
Yes.
Certain kind of active business income. Wow, amazing stuff. Well, this has been great, Virginia, as always. You know, great blog post on a topic that very few people think about or even aware of, probably because of the complexity. And where would people read more of your great blog and get in touch with you and all that good stuff?
Right. They can go to my website, and we have many blog post categories, a separate page listing out all the categories. So people who are looking at expatriation, people who have foreign spouses, all of these wonderful topics can be looked at on the blog. And they can find me at www.us-tax.org. And funny enough, I've had people ask me, what's a hyphen? Okay, let's do that one again. www.us, little dash, not an underscore, tax.org. So hyphen is just a little dash.
All right, that's great. It's a fabulous blog. I've been reading it for years, and all those people out there who are interested in learning more about the U.S. tax system, I think this is a great place to start. Okay, well, thank you very much, Virginia, and I look forward to our next podcast.
I do too, John. It's always a pleasure. And you always give me a new perspective in one way or another whenever we have one of these podcasts. So I thank you for that.
Oh, likewise. These are great discussions. All right, well, till next time. Thank you.
Take care, John.